A lot of you guys are interested in the cloud business. That's why a lot of you guys are interested in Alphabet, Alibaba, Tencent, Microsoft, and Amazon. But what if I told you that there was another company helping other businesses achieve and build out their digital core? And that's what I'm going to cover in this video. So guys, as you smash that like button, let me run that intro. What's up guys, and welcome back to the channel. And the company that I want to talk about is Accenture in this video. And you know what it comes down to is that yes, cloud-based offerings are available. However, how do you take your business and get it onto the cloud? What do you even sort of put onto the cloud? How do you optimize it? How do you secure it? Who gets access to what? Like who do you use to answer all of these questions, especially if you don't have the expertise in-house? Well, here comes a company by the name of Accenture. Now, there's a whole bunch of consulting companies that can help with this, but Accenture is largely known as a sort of like a digitization powerhouse. Their technology consulting segment is I would say, one of the leading consulting or technology consulting segments in the world. And so let's dive into this. So I just wanted to start off with their share price. Now, you know, by the time this video comes out, the share price might move a little bit, but right now it's down approximately 20%. And once again, it's one of the companies growing out the cloud computing industry. And I'm going to show you exactly how that's working. And, you know, I just wanted to quickly talk about the analyst price targets for this. So of course, you know, the company really only has an 11% upside according to analysts. And what this means is that it kind of tells me that at least in the near term, the company might be priced fully, despite the fact that it's declined significantly. However, you know, I always like to remind you guys that analyst price targets are only sort of like 1 year price targets. And so you really have to do your own valuation to determine the intrinsic value. And they're determining that the 1 year price target, so the price at which it'll be trading at in 1 year, will be around $312 per share. So, you know, an 11% upside. So nothing crazy as it stands. And first, let's just start with what Accenture does. And so, you know, I think they will try and tell you that, you know, they're pretty much a one-stop shop for everything. And I understand why they're doing that. But really, you know, what Accenture has been known for many, many years is that they are a company that helps clients, and they spelled it out right here, use technology to drive enterprise-wide transformation. And I would say, you know, the main one is, of course, this first point, which is building out the digital core, which includes, and what I was talking about at the beginning of this video, moving them onto the cloud, leveraging data and artificial intelligence and embedded security across the enterprise. And so, you know, just, you know, the basics of just getting rid of your in-house server is a big deal already, but then making it faster, cheaper, more optimized, bringing in other applications. You know, you can get your whole accounting function onto the cloud, etc., etc. What this really does is it helps the company move into the second area, which is optimization. So, you know, once you digitize faster, well, you know, you can probably access digital talent as well. And what that really means is, like, you know, you create an enterprise where you actually can work from home and use these services, use like the cloud-based services that your company offers. I definitely do that. We have a host of products that we use. Everything's hosted on the cloud, and so I can use them from anywhere in the world and get the work done that I need to get done as you know, a leader in the finance space at the company that I work for. And then, of course, you know, the big sell with the optimization, of course, is reducing costs overall throughout the organization. So it essentially achieves the goal of becoming more competitive in your industry. And then, of course, you know, the last part, I would say that this historically has been the biggest revenue driver. It might not necessarily be the fastest growing segment anymore. You guys let me know. But, you know, they are finding ways to accelerate revenue growth for companies. So, for example, one way just could be leverage data and AI to enhance revenue growth. Now, one example would be that CarMax example I made in the last video that I put out, where CarMax is making it easier for customers to see the cars that they're searching for, and it makes it easier for it to show up in search. And so, of course, that would increase CarMax's revenue, transforming supply chains or content supply chains, and helping create new digital services and business models. And so, yeah, I mean, you know, there would be 1,000 different examples of what you can do with this segment, but I think the main bread and butter for this company is this building out the digital core and then optimization using those new technologies that are arriving into companies. And, you know, it's crazy. I almost think of every single single company as a technology company now, because they have to leverage this stuff. Otherwise, they're going to get left behind. And so, any company that I've worked for, at least over the last, I would say, maybe 7 years or so, everything's on the cloud now. And it's funny because I kind of started my career where not everything was on the cloud. The first company I worked for, of course, audit firm, we started off with nothing being on the cloud, and then everything just quickly went on. And all the companies that I've worked for subsequent to have everything predominantly on the cloud. So, the in-house servers kind of going away. And in fact, it might be gone away for many, many companies that are large in scale. And then, they say it right here: our managed services have become increasingly strategic as companies seek to move faster and leverage our digital platforms and talent, as well as reduce costs. And I think that's the real sell there. In fact, if you want to, I know this isn't their mission statement, but if you wanted to give them a mission statement, this is largely it. And so, in other words, they are leading the transformation to the digital age, which is what all of us have been investing in, what all of us are optimistic about. And this is just another piece of information that comes from their website that shows all the areas that they're in. I just highlighted some of the areas I think you guys would be interested in. So, of course, business strategy, cloud, automation, supply chain management, change management, finance consulting, metaverse. I don't know how much they're doing there yet, but, and sustainability is a big one too, because a lot of companies are being rated on an ESG perspective. But you can see here, this comes right from their strategy. We provide innovative and comprehensive services and solutions that span cloud systems integration and application management. Of course, the security that is involved in that as well. But notice that, they use a strong ecosystem of relationships with key suppliers, including, Adobe, Alibaba, AWS, there's Google, there's Microsoft, Salesforce, SAP, Workday. So, they can be a one-stop shop to sort of set all this stuff up. If you wanted to use AWS, but you also want to integrate Salesforce, and also, additional parts of your revenue stream as well, everything integrated together using the Microsoft suite. You can do that all through Accenture. So there's a real compelling reason why you would want to use a company like Accenture. Now, when it comes to the moat for Accenture, they don't do anything that you can't get from other consultants, but where the moat comes from is effectively, their size and scope and reputation. So when it comes to the reputation, Accenture has been known for its reliability and expertise in technology, and thus has become a top name when it comes to technology consulting. That's their bread and butter. That's why they win. They have an expertise in leading technologies, plus they have relationships with all those vendors as well. And so they just offer more services, and they're always on top of the increasingly complex businesses or products such as cloud and quantum services. I just threw quantum in there because I really don't know what companies are using this. Let me know in the comments if you guys know sort of like what companies are using this for, but we all know why companies are using cloud-based platforms now. And they have a ton of sticky clients because they'll offer the technology. It's not just a one and done in many situations. So they generally are high switching costs, which means that Accenture's clients, especially those with larger contracts, are very unlikely to switch providers. And so of course, especially when it comes to like reselling products that have renewals, of course. And then, of course, the scale and geographic reach. So, you're in a multinational company. You want to work with a multinational consulting firm. And so they have one of the largest workforces in the industry. They number around 730,000 people, 730,000 consultants. And, this, of course, Accenture is one of the biggest employers out of the, top MBA programs all around the world. And so there's a reason why these super smart people are desired to work at Accenture. And of course, the reason is because they're building out the future of business. Now, the first area that caught my eye with Accenture is notice that, of the free cash flow that they're generating, first notice that the free cash flow is increasing every year. And, the profitability remains in that double digits in terms of free cash flow as a percentage of revenue. So that's pretty cool to see. So as revenue increases, so their profitability maintains. And so, of course, there's just more coming to the bottom line. So that's phenomenal. But the other thing that I wanted to point out is that look at what they're doing with most of their free cash flow. It's all getting paid out in stock repurchases or paid out in dividends. So that's phenomenal. The only thing that I would want to point out, and it's a bit of a drawback, is the stock-based compensation as a percentage of free cash flow is pretty high at 25%. So, they might be buying back $3.2 billion worth of stock, but they also issued $1.7 billion. And so just keep that in mind as you value at this company. You do have to provide a discount for it. Now, if you value them using EPS, it's already embedded within because because stock-based comp is expensed through the P&L. However, if you're going to use a cash flow methodology, you got to make sure that you use a free cash flow per share net of expected stock-based compensation. That's something I always talk about on this channel. Nothing new for you guys who've been watching this channel for quite a bit. And just moving on to their balance sheet, the one thing that I did want to show you, and this is part of the Patreon model that you guys have access to at that lower tier of the Patreon. So if you don't have access to this model, you can join us at that lower tier. And notice that their return on invested capital is continuously high, always above 20%. I mean, it dipped a little bit lower, but it's because their excess capital, amount of cash is sort of increased on their balance sheet. You're not seeing it here, but if you get access to the model, you can. Well, actually, you can see it here. It's $8 billion right there. And so, when it comes to excess cash, they have no debt, so they'll be very resilient in a downturn. Yeah, revenue could go down, earnings could go down. That's okay. They'll be around after any sort of significant downturn. And this is a company that commands a premium because they provide exceptional services and products to companies that need it, and especially in times where they need it the most. So they got around $8 billion of excess cash. Now remember that number because that's going to be added into the valuation. You guys know how I do this. And so when it comes to the historical performance for the company, notice that fiscal year 2022, this is once again the model that the Patreons get access to. They actually provide us with 3 ways to model out the company. They use geographic markets, they use industry groups, and they use type of work, so consulting, management services, in other words, outsourced. And so notice that 2022 was actually a boom year. It grew by 22%. But when we forecast out earnings, we have to take into account that growth can and should come back to the mean level. So here's their CAGR. Overall, their CAGR was the high single digits, right? And so when we forecast out these segments, I forecasted out in all 3 ways. And I'm really making growth come back down to sort of like their mean levels. And just by looking at that previous set of financials, you could see why you would want to bring it down. A lot of people make the mistake where they'll just take the average of the last 5 years and forecast that out. Well, what happens if you have a boom year like 2022? That's going to skew your average, right? And so look at here. So notice that the Q1 2023 results are very interesting because notice how geographic presence or their geographic diversification is actually working against them thus far this year. Because notice that, like, for example, in their total geographic revenues are only up 5%. Meanwhile, in the local currency, it's up 15%. So kind of got to take that into consideration that, like, they're still growing in the first quarter despite the economic headwinds that we're seeing right now. And they're definitely growing in the local currency. So just keep that in mind. You're not going to have a stronger US dollar into perpetuity. And so when you just look at the EPS and you say, hey, EPS is slowing down or it's going backwards, you kind of have to get into this and see why. And so you're seeing this with a lot of companies. You saw this with Starbucks, saw this with McDonald's. You're seeing this with Accenture now, right? Revenues are up a lot over last year in local currency. However, you're not going to see that translated in their financial statements because they're translated in US dollars. So just keep that in mind. And so when it comes to forecasting out revenues, I'm not going to go through each of these, sub-segments. I did put a lot of thought into each one of them. So if you guys get access to the model, you can see how I sort of forecasted everything out. The orange is where I change a growth rate or whatever. And then if there's no orange beside it, it just means that it holds on to that growth rate. But overall, I'm growing revenues in that mid to high single digit level. So nothing's greater than around 6.5%. You got 7% here, you got 6.5% here. So nothing's greater than that. I'm not forecasting out a 22% revenue growth year. Notice that their CAGR, their 9-year CAGR is 9%. So I'm well under their CAGR. So if you guys wanted to pause here and say, listen, man, you're so much under their CAGR, you got to give them a little bit higher of revenue growth, you're not wrong. And so if you want to forecast this out with higher revenues, be my guest. I'm just being somewhat conservative in this environment because you never know what could happen in the future. And I like to be pessimistic in the way that I modeled the company out. Not a lot of people agree with that, but that's okay. I'm happy to just sit on the sidelines in the time being. And so what does my valuation look like? Well, I do believe that this company does deserve a premium multiple. And so 20 times is a premium in my world, at least. And so I'm valuing the company at around $215 per share. Now that $8 billion that you guys saw previously, it works out to around $12 per share. So I just add that to the valuation. But notice that the company's trading at 30 times next year's earnings. So it's pretty pricey. So it's trading at 131% of its valuation. But that really doesn't mean anything to me because we've just added it to the tracker and we'll wait. I'm not looking to buy it right now. It is an exceptional company. I would say it's like a top company if it wasn't for that high stock-based compensation as a percentage of free cash flow at being at 25%. I'd say that's the only knock on them, but I love the company. I love the business. I love that it's going to be more important as time goes on, and you could make an argument that you should grow out revenues higher, and so the valuation should be higher. But I'll let you guys argue that in the comments below. I'm always receptive to whatever you guys got to say, so let me know. Hit me up in the comments below. Now, the other thing that I do want to point out is that Alibaba is actually using a very interesting new method to generate higher revenues for international orders, and if you've missed that video, you can get to it right here.